Welcome to Part 4 of our seminar, Understanding Financial Statements. In this video, we continue our discussion of property, plant, and equipment. Our focus will be on accumulated depreciation, additions, and the book value of plant assets. Please make sure to print the PDF handout found below this video. We will be referring to the PDF handout throughout the seminar.
Excellent. The question is, how do we determine the depreciation on the building? Is there some formula? And I'm going to expand the question to say on any of these assets, because we're going to depreciate equipment and vehicles and furnishings, right? How do we come up with the rate? Is there some formula? Do we look for guidance? Well, the accountants work on principles, and we don't have any specific notations or specific years for any asset. On the other hand, the Internal Revenue Service does. The Internal Revenue Service on your tax return will tell you exactly what to do. But on our financial statements, to answer your question, on the financial statements here, we're driven by the matching principle. And the matching principle says, spread that cost over all the periods that will be benefiting from that. And so we say, well, how long will the asset be benefiting us? Not how long will the asset last. How long will the asset be useful for our business and what we do? So if I'm a graphics design person and I buy a really high-powered fancy computer and let's say it's $3,000, I might depreciate that $3,000 computer over 2 years on my financial statements, because in my business I need the state-of-the-art software, and the software wants more hardware, and so my machine might only be useful to me as a design person for 2 years. Now if I, on the other hand, as an accountant, buy a $3,000 computer today, I might be able to use it for 6 years, 7 years. What do we do in accounting? Nothing quite that powerful, right? We just move numbers around and print stuff out. So the useful life of a computer for an accountant is different than the useful life of a design person, where the software demands new technology continuously. Accounting doesn't demand that kind of technology. Okay? So the same for the building. How long is the building going to be useful to us? So we might say, well, 25 years, let's use, right? And then over at the IRS, they'll tell you what to do on the tax return. So it's important to note here that we're talking the depreciation for the books, for the financial statements, and that will be different than what's going to be on the tax return. And so people always used to kid, oh, you keep 2 sets of books. You have to. You got to comply with the Internal Revenue regulations. You can't go off course from their regulations. On the other hand, we're trying to measure profitability. So when we do depreciate these, the expense is actually going to an income statement, and we don't want to distort that income statement. Right? So today maybe the IRS says, write it off instantly if you want. We want to stimulate the economy. Great, do it. But over here, we don't want to write off a $100,000 piece of equipment in 1 month on our income statement and blow the financial statements out of the water. Right? So we're going to have 2 records for depreciation, the tax records and the financial statement records. And we'll even have more than that, because maybe the state we're in has a state income tax, and they may not have the same rules the federal tax people do, so we might have 3 different calculations going on. And maybe after the next tax bill, maybe there'll be still another one. Who knows? So, but we're focused on the financial statements, and we're trying to match. So to answer your question, how do we do it? It's a judgment call. We estimate the useful life. It's clearly an estimate. It's our best judgment what the estimate's going to be. So the matching principle drives us. And we don't care about the tax regulations for the financial statements. Now, the owner of the company might be pretty savvy, and the owner might say, well, if you depreciate my building a little too fast, you're going to hurt my profits, and I don't want to show low profits, or my banker's going to get nervous. So don't write that building off too fast. Don't do 20 years. Let's do 30 years. Can we do 30? And so, you know, there's pressure on this accountant to make the right judgment. But we're expected to act professionally and be logical in how long the asset will be useful. Now, going back to that computer, the computer is probably physically going to last for 100 years, right? All that material in there is not going to deteriorate. So that could go on indefinitely. But we might write it off in 2 years. Somebody else might depreciate it in 6 years. Even though physically it's going to last much, much longer. So we're trying to match expenses with revenues, and we're going to do it in a systematic, logical manner.
If you bought a building with the intention to sell it in 6 months, would you write it off in 1 year?
Okay, question is, what if you bought a building with your intention to sell it in 6 months? Would you go and depreciate it in 1 year? And the answer is no. These assets under property, plant, and equipment are assets that we use in our business. If we hold a building with the intention of selling, whether it's one we just bought or one from 30 years ago, once we're not having it in use, you cannot depreciate it. So only assets that are in use can be depreciated. So that asset that we just mentioned would go under long-term investments. So that building we just bought with the intention of flipping it in 6 months goes up under long-term investments. Even if you intend to sell it in 6 months, because we don't know it's going to turn, the accountant has got this conservatism principle. When doubt exists, will it get sold in 6 months, won't it? We're going to go with it ain't. Right? We're not going to see that building sold in 6 months usually. So it's going to go under long-term investments. And then when we sell it, of course, we'll put the cash up in the current assets. Okay? And of course, it'll be under investments at its cost, right? Not what we think we're going to sell it for. Okay, let's go on to equipment. That's stuff that's in use, right? If we bought something and it's not yet in use, we should wait till we place it into service before we start depreciating it, consistent with your good question. Furniture and fixtures, the same thing. So then we add up all those costs, and we show as a subtotal, and then we say less accumulated depreciation. Now the accumulated depreciation means all the depreciation we've taken on the income statement as depreciation expense from day one. So as long as the asset is in use, and it's listed here, we keep track of that asset's accumulated depreciation. Right? If we sell an asset, then we take the accumulated depreciation out for the one that got sold. So this accumulated depreciation pertains to the assets that are still in use. Now if an asset, let's say we bought an asset and we thought its useful life would be 5 years, and we fully depreciated the asset in 5 years, then we'd have the cost up above, and part of the accumulated depreciation would be the entire cost of that asset. And we keep that on the books. And then if we continue to use that asset into the 6th year, we will have no additional depreciation. Right? So we can never depreciate more than the cost of the asset. Right? You can only take its cost. Now, what you may find, though, is you're going to have a whole lot of repairs and maintenance expense. But the depreciation will stop as soon as we've depreciated its cost. Okay, so the question is, we've got assets with a cost of $239,000, less accumulated depreciation of $187,500, which gives us a net amount of $51,500. And the question is, because that $51,500 is so low and the accumulated depreciation is so high, can we assume then that there were no recent additions for property, plant, and equipment? Right? And that's very logical. It is not absolute, though, because it's possible that I just added, maybe it was all fully depreciated already, and now I just bought a new one for $50,000 and stuck it up on top. In other words, if I look back at last year's financial statement, maybe it was $180,000 already, and then and the book value was $20,000, right? You know, I'd have to have comparisons. So here's the better answer. The better answer is you look at the statement of cash flows, and it'll tell you exactly the amount of capital expenditures made. Okay? So I tried to give some logic to what you'd imply here, but you don't even have to guess if you have the statement of cash flow. So the statement of cash flow is the third one we're going to talk about, and some people think it's the most important, and it's the one that's least read. On that statement of cash flow, it'll tell you how much was spent for capital expenditures. So it's a phenomenal statement, and that's where you should go. So let's get back to what we're showing here. We had said then that the $187,500 of accumulated depreciation is the amount that's been taken for the assets that we have in use since those assets were purchased. And since this number is quite big in relationship to the cost, we got a pretty good indication these assets have been around a while. And so the book value then, the $51,500, the net of the cost minus the accumulated depreciation, is called the book value. And maybe the accountants starting to use the word carrying value. So the carrying value or the book value of this company's fixed assets, the property, plant, and equipment, is $51,500. Now the book value or the carrying value of $51,500 does not tell you the market value. So we cannot imply that book value means market value. Don't confuse our book value term with some automobile blue book or something. So our book value means very specifically cost minus accumulated depreciation. That's what book value means to an accountant. What's on the books, okay? And what's on our books is the original cost, which may be many years old, and some arbitrary estimated way to move that cost over to the income statement. And we call that depreciation. So, again, this company's assets might be worth a whole lot more than $51,500, might be worth less. So a key one would be that building and that land, right? If that land is in a good location and the building is in a great location as well, wow, we might have assets a whole lot more than $51,000 here, right? The market value of that building and land could be $500,000 for all we know. Depends, right? Depends how long ago it was purchased, at what price, at what cost, and what's happened since in that location, right? So we cannot tell from here what these plant assets or fixed assets or property, plant, and equipment are really worth or when they were purchased.